Most investors think they are holding safe, recognizable brands. They are not. By the end of this video, you will know exactly which stocks to dump before it is too late. Intel once stood as the undisputed leader of the semiconductor world. In 2023, the company reported GAAP revenue of $63.05 billion, a drop of $2.5 billion from the previous year. Management blamed weaker PC demand and delays in data center shipments, but the decline runs deeper than a single bad quarter. Intel's top line has now contracted for 2 consecutive years, a trend not seen since the dot-com bust. As rivals like AMD and Nvidia push ahead with cutting-edge chip designs, Intel's historic advantage in process technology has faded. The company's once formidable moat is eroding, with market share slipping in both consumer and enterprise segments. For investors who still see Intel as a safe bet, the numbers tell a different story. Legacy status is no shield against shrinking revenue in a rapidly changing competitive landscape. Walgreens once occupied a place in the American retail landscape that seemed unshakable, but the numbers now tell a story of retreat. Since 2021, Walgreens has shuttered 900 stores across the United States, a move that signals more than just a shift in consumer habits. This wave of closures comes as the company's total debt climbed to $30.2 billion by the end of fiscal 2023. On the surface, Walgreens still projects the image of an essential everyday retailer. Yet beneath that familiar branding, the company is scaling back its brick-and-mortar presence at a pace that would have been unthinkable just a decade ago. The shrinking footprint isn't a one-off adjustment. It's a sign of leverage that leaves little room for error. As interest payments eat into already thin margins, Walgreens is forced to choose between serving communities and servicing debt. For investors, the warning is clear. Even the most established names can become overextended, and debt can quietly turn a household staple into a high-risk bet. Boeing's legal troubles have now reached a breaking point. In July 2024, the company pleaded guilty to a federal criminal charge tied to misleading regulators during the 737 MAX crisis. The U.S. Department of Justice imposed a $2.48 billion settlement, one of the largest penalties ever levied against an American manufacturer. This is not a one-time expense tucked away in a footnote. The cash outflow hits Boeing's already strained balance sheet at a moment when the company is fighting to restore its reputation and stabilize production lines. Every dollar paid to settle legal claims is a dollar that cannot be spent on engineering safety upgrades or new aircraft development. For investors, the warning is clear. Legal liabilities of this scale are not just a headline. They are a direct drain on cash reserves and future growth. When a company is forced to plead guilty and pay billions to regulators, the risk extends far beyond management missteps. It becomes a structural threat that can haunt the business for years. Paramount's streaming ambitions have run straight into a wall. The company's own filings reveal a net loss of roughly 2 million streaming subscribers year over year, a reversal that stands out in an industry once obsessed with growth at any cost. For years, Paramount leaned on its deep content library and recognizable franchises to lure viewers, betting that household names would translate into lasting digital momentum. But the numbers now tell a different story. As competitors flood the market with original content and aggressive promotional tactics, Paramount's subscriber base is shrinking, not expanding. The loss isn't a blip or a seasonal dip. It's a sign that simply owning popular shows and movies is no longer enough to guarantee growth in the streaming era. Investors expecting a steady climb are instead watching the foundation erode. Paramount's failed pivot exposes a broader truth. Even legacy media giants can falter when the market moves faster than their strategy. SolarEdge Technologies was once seen as a pure play on the green energy boom, riding a wave of optimism around solar adoption and the global push for decarbonization. But the numbers from fiscal year 2022 tell a starkly different story. Revenue dropped 12.2%, falling from $1.66 billion to $1.46 billion. That is not a seasonal dip, but a fundamental contraction in demand for the company's core inverter business. While competitors doubled down on profitability, SolarEdge spent $300 million to acquire Hark Systems, a bold move at a time when cash generation is under pressure. The acquisition was pitched as a strategic pivot into energy management, but it came just as the company's top line was shrinking. For investors, this is a textbook case of chasing growth at the wrong moment. Sector tailwinds cannot offset the reality of negative momentum and expensive bets that may never pay off. SolarEdge's story is a warning. Even in hot sectors, bad numbers do not get a free pass. If you're finding these forensic breakdowns useful, now is the time to subscribe. Every week, we cut through the headlines and examine the numbers the big brands hope you'll overlook. Whether it's collapsing margins, mounting legal bills, or debt that threatens to tip a company over the edge. Staying informed means more than just tracking the news. It means understanding the forces that can quietly erode even the most familiar names in your portfolio. By subscribing, you'll get early access to each new investigation, along with the data and context you need to make smarter decisions in a market where yesterday's blue chips can become tomorrow's cautionary tale. Don't wait for the next earnings shock or regulatory headline to catch you off guard. Hit subscribe and make sure you're always one step ahead of the risk. Tupperware's collapse reads like the final chapter of a once-beloved brand. On November 2, 2022, its share price plummeted 42% in a single day, wiped out by a disastrous earnings report and a mounting sense that the company's business model was running on borrowed time. That was not a temporary setback. By September 2024, Tupperware filed for Chapter 11 bankruptcy protection in New York, with more than $1 billion in debt and no viable path to repayment. The company's direct sales network, once the envy of consumer brands, had shrunk by over 40% since 2019. Revenue fell for 7 straight years as digital-first competitors and shifting consumer habits left Tupperware stranded. The bankruptcy plan leaves shareholders with nothing. For investors, the lesson is clear. Nostalgia and name recognition cannot protect against a balance sheet that is underwater and a business model that has lost its footing. In its 2023 annual report, 3M's financial statements reveal a risk that many investors continue to overlook. The company recorded a charge of $1.03 billion tied to asbestos litigation. This isn't a theoretical or contingent liability. It is a GAAP-recognized expense, booked as the best estimate of expected cash outflows for future settlements and judgments. The charge alone amounts to nearly 4% of 3M's total revenue for the year and more than a quarter of its net cash from operations. Management insists the company can manage these payouts through ongoing cash flow. But the legal overhang is only growing. Beyond asbestos, 3M faces billions more in pending settlements for PFAS chemicals and defective earplugs. Each new accrual chips away at the company's ability to sustain its 65-year dividend streak. For shareholders, the warning is clear. Legacy brands can carry hidden liabilities that quietly erode value, turning a once dependable blue chip into a source of mounting risk. Alibaba's story is a warning that even global giants can lose ground overnight. Between the end of 2021 and the close of 2023, Alibaba's market value dropped by $82 billion. This was not the result of a single earnings miss or a fleeting headline. It was the product of relentless regulatory pressure from Chinese authorities, antitrust fines, data security crackdowns, and the government's push for common prosperity that forced the company to restructure its core businesses and suspend new fintech products. Each intervention chipped away at investor confidence, and by late 2023, concerns about forced delisting and unpredictable oversight left Alibaba's once unassailable position looking fragile. Dollar General, long seen as a recession-proof safe haven, is now facing a different kind of squeeze. In fiscal 2022, revenue fell 4.9% to $34.2 billion, the company's first top-line decline in years, but the pressure does not stop there. Dollar General's debt load climbed to $6.9 billion, raising questions about its ability to weather further downturns. Rising shrinkage, supply chain costs, and store overexpansion have all eroded margins. The myth of the discount retailer as a defensive bet is wearing thin. When even the biggest names in global commerce and discount retail start flashing red on debt, margins, and regulatory risk, the old rules about safety no longer apply. Today, familiar brands mask crumbling foundations. Debt, litigation, and disruption are not distant threats, but present realities. Name recognition no longer protects your portfolio. Structural decline is unfolding in plain sight. Review your holdings with clear eyes, subscribe for the next expose, and scrutinize everything you thought was safe.